think the top two considerations at the moment is where is your private investment allocation relative to your target? That's a lot of investors are carefully watching where their actual allocation is because a lot of folks are bumping up against their target. You've got to really keep an eye on that. And I think the other consideration is how much dry powder do you as an LP have waiting to leg into the market unfolding in front of us? I think those are two very clear considerations as LPs continue to have to contemplate committing capital or investing in this environment. Yeah, the rocky geopolitical climate coupled with a lot of economic and macroeconomic volatility, right? Interest rates are rising, inflation is high. There's a lot about this market environment we as institutional investors haven't really experienced before. One would think that perhaps the established manager who has some experience with market cycles could continue to attract capital above and beyond maybe that of an emerging manager. However, one of the things we've observed at Cambridge Associates is that there is more return potential typically with emerging managers. They align themselves to be the firm of the future, right? To sort of breaking free, like Ariana Grande says, to be something a little different than the firms that they were a part of. And so emerging managers, we believe, often do represent where the private markets are going. And so we typically encourage and have our clients invest, always save a little bit for emerging managers because they're very aligned with with you as an investor. Their backs are against the wall to earn that return to get to a fund 2 or a fund 3. And they may actually have built the skill sets to navigate the market in front of us in a more future thinking kind of way. So it's rough for emerging managers right now. It's never easy, but I actually think a little bit of both probably is the way it's really going to go. This is such an interesting question because we've been through a couple-year period where it seemed like GPs would raise capital, deploy it kind of quickly, and then come back and raise maybe even a multiple of the funds that they raised before. I think one of the questions as an LP we have to deal with is this a permanent change to the private investment market environment, right? So if a GP who typically may take 3 to 4 years to invest their capital suddenly is only taking 2, then I may need to have my commitment because I, as an investor, I'm trying to make sure that I have the same amount of capital going into the market in any given year. And so the interesting thing about this compressed fundraising cycle is it permanent or not? And then as an institutional investor, I may need to have my commitment. And then what happens if that GP actually ends up, again, taking the full 3 to 4 or even the 5-year legal length of many investment periods? It's not an easy market to navigate as an institutional investor. So what do I think about it? I'd like to believe it's temporary. We've actually seen this before, right before the GFC. Same exact behavior, actually. And so it could just be temporal. It definitely doesn't rhyme with what's happening right now, right? In terms of history, may not repeat itself, but it does often rhyme. There are some elements of it that echo back to the global financial crisis, just as you'd said, Emma. And one of the things that we observed is back in the day, fund sizes more than doubled. Capital was coming into the market. Investment periods were quite truncated. Exactly the same market conditions. What we did observe as Cambridge Associates, using all the information that we gather and incorporate into our own investment approach, we noticed that the returns of those GPs was actually quite significantly down from the prior fund. I mean, think about it. If you invest money quickly at the top of the market and then there's a downturn, then you have to sell into a market exit environment that is not favorable. So your returns are hurt, right? In addition, you also have this challenge of maybe you raised too much money, and so now you're no longer even investing in your strike zone. So we actually observe both of those concerns today. A lot of GPs raised maybe double their fund size, took them up and out of their strike zone investment arena, and they may have invested at peak valuations. And so in order to earn those private equity, private investment returns we're all here for at SuperReturn, those GPs had better have the wherewithal and the resources to deliver on their stated return. we are concerned. We are concerned. There will be pressure. There will be pressure.